a conceptual question. A reader and someone from the audience has asked us this question. What is the difference between value and growth style of investing? And is there any research in India that validates the superiority of one approach over the other? आप लोगों ने कभी कुछ research किया है? And what is your recommendation?
नहीं, हमने रिसर्च किया है कि हम रोज ही नंबर कैलकुलेट करते हैं और जो नंबर है वो तो क्लियरली बताता है कि वैल्यू हैज बीन आउट ऑफ फेवर और एंड दैट हैज बीन द ट्रेंड ग्लोबली and growth and value is quite self-explanatory. Here is growth is a strategy whereby people are betting on a company which is expected to grow faster and grow rapidly, as compared to value where something is considered to be relatively cheaper than its intrinsic worth. And value has been on a struggle. Warren Buffett is also struggling relative to on a 10-15 year basis. His performance is not able to beat S&P 500. But in India, I would say that go for growth. Value has been struggling for a long period. But I also have a belief, have some allocation if you have a larger portfolio, and which many funds are able to factor that in as well. That things turn around when you least expect it, and I think you can't really write it off. Having a component there, and that is what we have witnessed in the very recent past. Last 5-6 months, I'm witnessing that value is making a modest comeback. I don't know if it is sustainable, but I have this great belief in reversion to mean. Things don't die, and and it's so compelling that something which is and people have gone about modifying the definition of value in multiple ways. Fund manager implement that strategy in a different way in conjunction with growth as well. So have some allocation to value as well.
Okay, great. Now, gold is the flavor of the day. So our reader, Suresh, is wanting to know, is gold ETF a good way to invest?
Gold ETF is a reasonable way to invest because, and look at the options. What are your options? Buying jewelry, buying bars, buying coins from the banks, buying a gold ETF, buying a gold fund, which in turn invests in gold ETF. And then you have another option called sovereign gold bonds. All the options except sovereign gold bonds that I have listed here, they have a cost. They have a cost of, making charges, holding it, going out of style, ensuring purity in the first couple of options. ETF comes with a cost. And a gold fund, which in turn invests in a gold ETF, also comes with an extra cost of managing in a mutual fund format. Sovereign gold bond is the only option which earns you 2.5% more than the gold prices issued by the government of India. So I hope that government will never default on its promise to, if you buy those bonds today, you buy today's gold prices. 8 years from now, government will honor the then prevailing price, and you get 2.5% extra every year, plus tax efficiency. It's exempt from long-term capital gains. No other option is. So in that sense, it's that is the finest way. Next best is gold ETF.
Okay. We have a reader. We have another person from the audience. Her name is Mrs. Mansi. She's a 60-year-old widow. Her 2 children are settled, and she has about 4.5 lakh to invest today. What would you recommend to her?
I don't know if what is the expectation from this investment.
No, she hasn't answered. But what would your rule of thumb be for someone who's 60-year-old? Her children are settled, so I'm assuming that financially she's stable. I'm assuming she's in good health, and I'm assuming she can take a reasonably moderate amount of risk.
There is a widow who has no income requirement. Assuming she has and this is just the money which should grow safely. If that is the orientation, then maybe this 4.5 lakh rupee to be invested in balanced fund over the next 12 months.
Okay.
But in spreading it over the next 12 months is important for a person like her, simply because the whole anxiety of investing and seeing the ups and downs very closely soon after you invest is very troubling. And investing and so spreading it is important. Balanced fund, because it will be moderate. It will not. It is a steady take on growth, so that will be relatively unlike an equity fund.
Okay, now one of the things which a lot of lay investors struggle with is how do they select a mutual fund without breaking their heads over getting into the details and fundamentals, looking at the portfolio, track record, CAGR. This is all very alien to many of them. What would be your rules of thumb, or would you say that it is a complicated process? Either come to value research or go to an advisor.
Yeah, come to ValueResearch. We will help you. We will help you choose one, and very soon you will have a mechanism that you can specify your needs, and we'll tell you precisely the one which you need. That's one. But I think you spend so much time, effort, and energy in earning that money, and then spending that, and the leftover. Spend some time. But I think there is a simple way. You don't have to really get into or complicate the whole process. Look for a fund which is, I think, the first battle is, choosing the appropriate fund. That is where many investors go wrong. And you can simply simplify this whole process. There are 16 kind of equity fund and there are 16 kind of debt funds officially, mandated by SEBI beyond, all the kind of closed-end fund and FMPs and other things. So there will be, something like 40 kind of mutual fund. You don't need all of them. You need, most investors' needs are fulfilled by 4 or 5 kind of funds. Somebody like that widow or somebody getting started, start with a balanced fund, you're done. Start with choosing the most. So that is the first battle. Be very precise, be very careful with that. Read 1 or 2 articles at ValueResearch online, which is the most appropriate fund for you. And 4 or 5 kind of fund will fulfill your needs, most people's need. Then comes, which is the best fund of that kind. I think, go to the ValueResearch page, look for the 5-star and 4-star universe, look for the 5-year graph, check for 2 things. A fund which has done little better than the benchmark in a falling market as well as a rising market, and the fund manager is still around. I think if you'll be left with very few options, and they're good funds to have.
Okay, we have another question from Joshi. He says, where should a retired person invest from his pension? He has 20 to 25K every month, which he wants to utilize towards this, and he's in good health.
Oh, he's very lucky to be able to save and invest from your pension.
Yeah,
I think I will actually treat him like a beginner, and I will, 2 kind of funds will actually fulfill his needs. He's investing from savings from his pension, which means that he might be, depending on what his income is. If he's in a tax bracket, he should start with 25,000 rupees, 12,500 rupees should go into a tax saving fund. Tax save is money earned, and the remaining money can go into one balanced fund. Because of course, this money is for long term. He might be a season, and this might remain invested for a long period of time. But in retirement, because your income scales down, or you think, or you're temperamentally not very comfortable with big things, that will be a steady, take on growth. When I'm referring to, I'm actually, I'm telling it wrong. When I'm referring to balanced fund, I'm referring to the now. It is embedded in my mind for all these years. This is the aggressive hybrid category I'm referring to. We don't have great balanced fund. I wish, we have those balanced funds, genuine balanced fund. But this category has been created, but it is not filled with any nice fund yet. So I'm referring to the aggressive hybrid funds when I'm referring to balanced fund here.
Okay. Now, I know that this is a very simplistic question, but this keeps coming up in all my conversations with both advisors and investors. What is a reasonable rate of expectations from an equity fund over 10 years? Reasonable rate.
Yeah. Reasonable rate will also keep changing because, my reasonable expectation is inflation plus, depending on the risk, maybe, a dynamic bond fund, I will expect, 1.5 times of the inflation rate as the reward for owning a dynamic bond fund. And for assuming the equity risk, I would like to have, 100%, 150% of the inflation rate. Given the complexity and the mortality and the risk that we take and the diversification and all that will happen in the portfolio. You will have companies which will die. You will have companies which will go out of favor. You will have companies which will succeed substantially. a combination of all that, I would like to have, my reasonable expectation will be 1.5 times that of the inflation, or maybe 50% more than, the risk-free rate that we earn. And the risk-free rate that we earn even today is 7.15%. From the RBI bonds, Government of India bonds. So, I would say that my least expectation from a diversified portfolio to be held for about 7-8 years will be, 10.5%.
Okay. Now, Imran wants to know, should Indians be looking at international funds?
Absolutely. And most, definitely. It gets, simply because it's a meaningful diversification. You get great companies which of a kind which is not just complementary. I think it should be mandatory. And we have great options and easy ways to invest today.
But for a long time, we've held the belief that our economies are growing faster. There are easier opportunities for making money here.
Yes, it has been so. But, the unique companies which are making money, and if you look at, it's a meaningful diversification. Of course, one should not be investing in I still hold that thought for the diversified international fund. That is not working. At the heart of it, the investment should be a performing one. And then comes, if it is not in India, then, you are able to meaningfully de-risk yourself. When I look at the US domiciled funds or in the special few vehicles, and because, they might be domiciled in the US, but they are global businesses. They have competitive advantages, which is not easy to replicate. The kind of businesses which dominate, a business which comes out with an innovative product and rules the world, and you don't have to get a substitute. Think of, we are using Zoom, and you have a couple of funds whereby Zoom will be part of that portfolio. It's a listed company. So, something that scale, the kind of businesses, technology-led innovations, those avenues, I think, they're quite unique businesses. And that is the other added charm.
Okay. The next question is, I invested in an infrastructure fund in 2008. What should I do?
If you haven't run away so far, what can I say? Run away now.
Run away now?
Yes.
You think the tide won't turn?
It will turn, but it has tested patience. And I think there was never a case for infrastructure fund. Even in the infrastructure boom, I used to say that. Infrastructure is nothing but a diversified equity fund minus technology, pharma, and FMCG. And any fund can actually be tilted towards infrastructure or not when they want to. Why hang around with something which has been a loser for so long?
Okay. Now, this is a very frank question, unlike many investors who make big claims about their capacity for risk. So this is, I'm a passive investor with low risk appetite. I'm looking for steady growth with payout over 10, 15, 20 years to cover my child's education and my retirement. What are the safe bets for continued investing for low risk passive investors?
Low risk passive investors, I keep getting back to those. I think there is a case for active active management as so, not in the context of the active and passive, not from that point of view. I think the aggressive hybrid equity fund I'm referring to, that actually gives you, when you are saying passive, you basically mean that I want relatively stable, not the madness of the equity market which we see, which gets captured in equity funds as well. And there are different kind of equity fund which are more volatile. So either a multi-cap fund which will be steady, but aggressive hybrid fund will do that better. That's one, and just be at it for your long-term goals. Don't get distracted. Maybe 2 funds, investing regularly, save as much as you can, and don't look at it every day.
Okay. Now, another question is, I invested in a fund because of the reputation of the fund manager. But the fund manager has quit now. What should I do?
If that was your primary thinking, you get out of the fund as well. Fund manager is the driving force of a fund which actually attracted you. And if that fund manager has quit, things do change. Sometimes they change for the better. But there are many funds. If you just got attracted to the fund because of the fund manager, follow the fund manager.
But would you advise that maybe needs to be a little more patient, wait and watch?
Maybe not, because there are recently I've seen funds where funds were struggling. A lot of people got attracted to a fund because there was a new fund manager, and now he has quit. So unless there is some process, some mechanism, something which you can find is attractive. Otherwise, if you just were attracted to the fund because of the fund manager, maybe one should follow the fund manager.
Okay, there's a question from Mani. He says, I'm expecting the market will fall when the earning results come out. Most of the companies are going to show negative results due to this pandemic. Do I need to stop my SIP in my small cap funds? Which have been invested for the past 5 years.
Invested for the past 5 years, the returns are, one could have made this case even 2 months back, 3 months back.
Yeah.
And today we will be regretting that. The only reason why you should, change your allocation, do a little bit of that. If you had an allocation plan, asset allocation plan in your mind. Otherwise, do nothing if you still have time on your side. If you need the money next 2-3 years, maybe you should gradually pull your money out anyway. Because your hypothesis is not working. Results are pouring in. Every day I watch, many corporate results coming, and the stock price is going up despite disappointing results, but not as disappointing as expected. So market has its own mind, and it's very difficult to anticipate. Don't do that. We have absolutely no control on that. And if all the information, all the anticipation is very much reflected in the stock price, difficult to guess in the short run. So I think your timeline, your needs, your time, your requirement, your goals should guide that decision than the state of the market.
Okay. Dhirendra, what are your thoughts on the stamp duty imposed on buying and selling in mutual funds? How much will it impact if the gain is more than 1 lakh?
It's a trivial amount of money, and it does not require my thought, because it's law of the land and you have to comply with it.
And so just go ahead, ignore it.
It's an ignorable amount, and it's an insignificant amount. But that apart, we don't have a choice. You just have to pay.
Okay. Now, Dhirendra, what are the red signals which tell me that I should exit the fund?
When the fund changes track, those red signals don't come. They don't suddenly blink from yellow to red. It happens gradually.
Okay.
You like a fund because it is doing better than others. You like a fund which is doing better than the benchmark, and it keeps doing it consistently. And even in a falling market, even in a rising market, when you see a reversal of that, many great fund managers also go out of favor. Their winning streak doesn't work anymore. Things change. Their preferences change, or market has been, something has changed which they are unable to, reconcile with. So when things change, and you can figure it out over some 1.5 year time period, and that is the kind of time which one should allow. There could be a brief period when a fund is not doing very well as it used to relative to others, because many a times, in a falling market, everything looks bad. But one has to take a relative view there. The rewards that you get from equity through a fund is a reward for holding through that lean period as well. So look for that 1.5 year time period. Try and understand a little bit. Maybe a fund manager change, if it is triggered by that, maybe you can decide on more quickly.
Okay, I know that you would be getting this question also very often. What should be the one single most important criteria in selecting a well-performing fund? Single most important, or is it not as simple as that?
Relative superior performance over a full market cycle, not 1 year return, or not 6 month return. That is the single most thing, and one full market cycle. Before that, one may not actually judge anything. It does not make any sense. There are kings of rising market, and there are great funds, resilient funds of falling market, and they don't really make up on the other side. So a full market cycle of performance is the single most thing which that's the starting point of any of my fund review.
Okay. Now this is a question actually from me. Okay, there are 32 fund categories.
Mm-hmm.
Okay, and while the AMCs obviously know the difference between each fund, the investor is left very confused. Okay? And while there may have been regulatory reasons behind the classification, I want you to recommend two categories rather, core categories, which represent the characteristic of equity. So two equity categories, and I want you to recommend two debt categories. In debt, one for the short term, very short term, and one for the medium term. In my definition of medium term, in a debt context, is 1 to 3 years.
Yeah, and also from an individual investor's point of view.
Yeah.
Because companies can figure out things for themselves anyway.
Yeah.
I think most Indian investors' need will be fulfilled by that aggressive hybrid category I'm referring to, and a multi-cap fund or a tax-saving fund, depending, because even tax-saving funds are multi-cap funds, except that they get you the tax break. And for somebody who has to invest 1.5 lakh rupees, that tax-saving fund is good enough. Beyond that, look for a multi-cap fund. So I'm saying that tax-saving or multi-cap fund for equity. For first-time investor, for old investor, for investors looking at a steadier take on equity, they should go for this aggressive hybrid fund, and they can safely ignore the rest of it. Multi-cap will capture most of the things that we talk about, the small cap, the mid cap, the infra, something, and that is what we pay for. We pay for the full, we pay the full fee for a fund manager. We should derive the full benefit of, getting something, because if you come and, all the complexity that you see is rising because of, need to tell a story, which does exceptionally well at some point and doesn't do well at other times. So these are two categories, which fulfill most investors' need. When it comes to fixed income fund, I will go with ultra short-term bond fund and short-term bond fund. I would not venture into long-term or medium-term at all, because the risks there and different kind of risk lurking. And this is still an evolving industry. The underlying, there is a fundamental flaw in the mutual fund industry, which is the underlying is not as liquid as the investor expects it to be. And someday these accidents happen. And when the accident happens, there is a new kind of risk which always happen in fixed income category, which is not a risk as such. There is a design of the thing. That is the design of the fixed income fund. Most fixed income accidents happen only when investors, a lot of investors run away from the fund, and that is not factored in any of the offer document or the management of the thing. And the underlying is illiquid. So this is a risk. In bad times things get nasty. So with that in mind, I would say that most investors can do without all the complex categories which mutual funds provide. They can do with a short-term debt fund, an ultra short-term bond fund. Look no further. All other things, they will have the risk, hitting you when you least expect it, and you will not be in a position to do anything about it, because there is a structural flaw in the way in what investors expect from a debt fund and the way where they have to invest.
Okay, Dhirendra, one last question, and you have been observing the mutual fund industry since 1990. You've completed 30 years. 1990, if I remember correctly, there were no private sector players. There were a handful of public sector players, right?
Yeah, there were 8 of them.
Sorry?
There were 8 mutual fund companies and dominantly public sector. Only public sector.
Only public sector, correct.
And there was no mutual fund regulation.
Okay. Now the industry has come a long way. How confident do you feel about recommending mutual funds day in and day out today compared to what the situation was 30 years back?
I feel more confident recommending mutual funds simply because, things are much more tightly regulated. I know things that, people can go wrong, but people can't do crooked things. And that I'm more assured of. And the complexity is rising, and so is with most other things, most other dimension of our life. So in that sense, mutual funds have become complex, and I think it saves my job simplifying things. And I think we'll be very relevant simply because the industry and everybody will be complicating and simplifying and cutting through the clutter, and helping people stay on course, holding their hand. And now the design, the transparency, other things. In fact, Indian mutual fund relative to all elsewhere in the world. I think they have set a new standard in transparency, cost, design, framework. We are way ahead of others, and in India that has worked very well because transparency brings in a very different kind of, discipline in the industry.
So you would go with the AMP campaign, mutual fund sahi hai, obviously.
Mutual fund, uske alawa kuch hai nahi.
Fantastic. On that note of optimism, we come to the end of our session. Thank you, Dhirendra.
Thank you.
I had a wonderful time talking to you.
It has been my pleasure. Thank you for having me.
Yeah. Bye-bye. Bye, Dhirendra.